courtesy of a stock card. And today is December 3rd, 2019. And we are looking at a Chinese company called Yiren Digital, ticker YRD. This company is a company that has been on a stock card's 2019 watch list for a while. We added it to our watch list quite early at the beginning of the year, and it has been one of the worst performing stocks that we have been monitoring and watching on our 2019 watch list, and that's why today we are talking about it. If you've been with us in the past couple of days, we have started our annual, and every year about the time in December, we clean up our universe of the companies that we are monitoring. We get rid of the ones that are not worthy of a spot anymore on our portfolios, on our watch lists. They're not worth of our time. And we add new companies that potentially are worth paying attention to. We started this effort quite a couple of days ago, and we are now down to 115 stocks on our watch list for 2019. And the goal is by the end of the year or so, we have 0 of these companies on our watch list, and we can start the new year with a fresh and clean canvas, if you wish. And another thing I have to tell you before we jump into Yiren, ticker YRD, is that we started from the companies that they have been performing the worst. We've cleaned them up gradually. The reason for that is that we always hopeful that one of the companies that have lost the most on our watch list are actually well-managed companies that might be good investment picks for our new portfolios in 2020. That's why it's always good at looking at companies who've lost the most in your watch list in order to pick up those good companies at a great price. Anyhow, let's see whether ticker YRD Yiren fit that bill and whether it's a company that we will be investing in it in 2020. All right. So we added this company almost a year ago about the same time on the 18th of December 2018. We added the company to our watch list. At the time, it was $13.14. And unfortunately, between then or maybe fortunately, we're gonna see, between then and now, as of today, the stock price have lost 63% of its value, and it has underperformed the overall S&P 500 by 88%. So good thing that we didn't pick up this company at the time and we only added to our watch list. So let's go and take a look and see what's going on, why this company is not performing, and whether it's worth a spot in our watch list, whether it's a good time to invest in it or should we cast it away. Okay, so this company, the first thing that would come to your attention most likely as you would look at the company's stock card is that the company has a very pessimistic bunch of investors. Investor sentiment about the company is very negative, and it's no surprise because look at this 1-year stock price chart. From January, it was just doing not very well, kind of went up and down all the way to May. And since May, basically, it's been a downward slide all the way with not much of breathing in the middle. So it's good. Let's just see whether what's going on with this company and why the investors are so pessimistic and why the stock price has been declining. I'm very excited about it because potentially this could be an investment that we pick at a very, very good price. The other things that would probably come to your mind right off the bat is that if you've been following this, change his name from Yiren to Yiren Digital. It's a New York Stock New York Stock Exchange listed company, and it is operating in a growing industry, which is good, but it has a stable operations. Past investment return hasn't been very clear, and as we just said, because it lost so much of its value, it's now in an undervalued range. So let's just go through quickly and see what's going on with the company, who is this company, and whether it's worthy of a spot in our portfolio or not. First thing, if you're not familiar with what this company does, let's just take a quick look at it. It's a fintech company in China, and it is helping connecting investors and individual borrowers, and company provides an effective solution to address largely underserved investor and individual borrower demand in China through online and offline channel to effectively match borrowers with investors and execute loan transactions. So let me translate that to English, I guess from English to English, but in an everyday language, this is basically similar to Square, or something is similar to similar to Lending Club in the United States. It's a peer-to-peer lending platform. Obviously, it's in China, so there's some offline things happening as well. So let's say you were an investor, you've got a bunch of money, you offer that to the platform, and then somebody else who is in need of the money come to this platform and borrow that money from you. So instead of going to bank, basically come to his or her peer. Hence the term peer-to-peer lending. It is basically in this peer-to-peer market. It's also not that big. It's only $500 million, almost $500 million in market capitalizations. And as you see, the company basically doesn't pay any dividend. There's no, the company is a dividend paying company. There was in 2017, they had a dividend payout, but since then, we haven't seen any ex-dividend, any more dividend information about the company. So there is something going on. At some point, it was a dividend paying company. We don't have any back in 2017, so there were no dividend paid after 2017 in 2018. And there hasn't been anyone announced. It is in peer-to-peer market in China, but as we've seen, if you take a look at the company's past performance, which is unclear. And if I click to see the detail, in the past 3 years, in the past 1 year, and the year-to-date total, meaning to 2019 up to today, the company has significantly underperformed the average S&P 500 index. So had you invested even 3 years ago in this company, you would have lost a lot of money. And as we saw, there was some dividend at some point, but there is no more dividend right now. The decline that we saw in the stock price has led to a stock that is significantly undervalued. The 12 months price to sales ratio of the stock is 0.35 times the company's sales. So basically, if you take the company's revenue as of today, the valuation that investors see for this company is only almost 35% of the current level of income or sales that the company has. And it's almost, the investors are valuing the company's almost the same amount at 1.0x of price to book value. Investors are basically saying that this company is just worth exactly that, the same amount that you can see it on its balance sheet. And price to E, or price to earning ratio, which is a very common, most of you are familiar, it's only at 2.37 times price to earning, so significantly undervalued. But now what intrigues me in order to figuring out what's going on is that why the company is so undervalued. Not every undervalued stock is a good investment, so we want to figure out what's going on with this company to deserve such an undervalued stock. I want to dig into something that I've read about the peer-to-peer market in China, and that's something that I came across to in several articles I've read about the state of peer-to-peer or P2B lending industry. This is an article on NASDAQ.com. And basically what is happening that across the world, there has been several scams and fraud and fraudulent activities and Ponzi schemes wrapped around the bow tie of peer-to-peer lending. And at some point, maybe about a year ago or 2 years ago, the market estimate for peer-to-peer lending globally was something like 50% annual growth rate. So here you can see that at some point the reports were that this market of peer-to-peer were expected to grow almost 50% per year in the next couple of years, 48% by one estimate and 53% by another estimate. But since then, there has been a significant regulatory crackdown on this peer-to-peer market. We've seen it some in the US with Lending Club and how the Lending Club's price has also been declining. But in China specifically, there has been a dramatic change in the market opportunity for this peer-to-peer industry. And that's really because a few years ago, basically, as you read these kind of articles about what's happening in the industry, is that there was a big one of the biggest players in the industry that went through what's known as the Ponzi scheme. And basically this Ponzi scheme came about when it wasn't Yiren that we're talking about, but it was another player in the industry that were just calling itself peer-to-peer, but it was some sort of a fraudulent Ponzi scheme going on. And a few of those things happened in China, and then regulators basically came down at the end and said, what we need to do is just do a significant crackdown on these markets. They need to, these platforms, they need to report their asset or the money that they are carrying to the government. And there's a whole slew of changes from a regulatory point of view came about that caused a company like Yiren to lose a significant portion of its revenue and operations to these changes in regulatory environment in China. And I found this page out of Q3 2019 quarterly earning presentation by Yiren, and then you'll see the company basically went through a significant transition in order to be able to adjust with this. So it's no surprise that we see the stock price has been declining. And even if I go and look at the sales growth rate, the company at some point it was really growing, but the estimated revenue growth rate right now is minus 30% for this fiscal year. And that's all because of those regulatory changes and what the company is actually calling as a strategic transformation in its business. So really what happened is that at some point the company, before these regulatory changes, it was called Yiren Digital, and it was an online P2P peer-to-peer lending platform and was focusing on unsecured consumer lending. It was facilitating loans, and it had a heavy offline, this is what the relatively heavy capital requirement, had a heavy offline presence. And then as it came about this regulatory and had to face to it, the company actually went in a sort of a part of a wealth management service provider called Credit Ease. And that's what you see. They say they have done a transition to become a digital personal financial service provider, consumer credit and wealth management. And they're not only focusing on loan facilitation, they're actually focusing on two things: loan and managing AUMs, is asset under management, basically model. So by selling themselves to this another company, Credit Ease, they were able to do something interesting. They were able to diversify away from that one just one opportunity, which was peer-to-peer lending, and be able to create some fast-growing or rapidly growing revenue segments as a result of this transition that they've made. And you can see that in geography segment growth rate on the company's stock card. All right, what really you can see is this a business in transition. from just being a peer-to-peer lending platform to also offering wealth management services to its customers or to its users. And you can see the result of some of these transitions are actually working for this company. So I want to show you how, when you look at here, two major things happen. We talked about how peer-to-peer unsecured lending, consumer credit and lending market has been cracked down globally and in China specifically. So from somewhere 50% expected growth rate per year, we're now down to 19%, justified by focusing on providing wealth management services to those investors who brought their assets to their platform. You know, let's say you wanted to lend your money to someone in order to earn a high yield, high interest rate on the money that you're lending to your peer, basically, hence peer to peer. Now this company Yiren has your assets there available to them. So through this strategic transformation they made and becoming a wealth management platform, now they can help you to also manage your wealth. From an investment point of view, from an investment point of view on your side, this is really a good move because it's now not only just a peer-to-peer platform, but it's also a company that potentially provides investment management services to mass affluent, growing mass affluent. So I totally get why investors are very pessimistic about this company, why money is flowing out, and why the relative strengths are aside, but all these basically momentum indicators are in negative. But it's interesting because not a lot of companies anymore, not a lot of investors are anymore expecting a significant short or decline in the stock. That's why you see there's not the big short interest on this stock. But I don't think overall the company yet has proven that it has strong operations in a way that it can recover from where it has been going in the past couple of quarters. But there are glimpses of hopes in there. So I'm not personally ready to invest in the company. I really want to see some improvements in this operation indicators. I want to see the sales growth negative rate to sort of turn towards positive. I also want to see that the company, maybe even some regulatory improvements in peer-to-peer lending in China could help the company become better, become a little bit stronger, and we could really feel that they can survive. So overall, as of today, I still believe this is stock worth a place on our watch list, so we're not gonna cast it away like some of the other ones that we've done in the previous episodes. But we're gonna keep watching this company for really those two reasons: the opportunity of providing investment management and wealth management to companies, to mass affluent population in China, and also the next thing is basically this whole, I guess, being part of Credit Ease as their parent company, give the company a little bit of more opportunity in order to be able to just hang around a little bit longer and kind of grow through these new segments. So there you have it. We're gonna keep the company on our watch list or add it to our 2019 watch list. And I guess next year, when we're getting to December, we're going to see whether this was a good decision or not. And maybe even sooner, we would be able to invest in this company if it has those signs of recovery. Well, thank you very much. That's it. There you have it. I hope you enjoyed it. If you have any company that you would want us to review from your watch list, make sure to put a comment in the comment section. And as our goal is, as I said, every couple of days, we're going to go through these 100 and something companies that are on our watch list and make a decision about all of them. one by one, and by end of the year or so, we're gonna get into our 2020 watch list and clean up this watch list and hopefully pick up a few stocks on the way. Thank you very much. Please make sure to subscribe or give us a thumbs up. You know how YouTube algorithms work. So if you enjoyed this episode, help us out. Your likes and your subscriptions will help us rank up higher on YouTube algorithm. Thank you very much. We'll see you soon.